Hi folks, Alex Klingelhoeffer here with Exencial Wealth Advisors. It's OKC CFA CFP on Twitter. I wanted to answer another question I've been getting recently, and that's what is an exchange traded funds? We call them ETFs here in the business. How do they differ from a mutual fund? What are some advantages? So exchange traded funds are the fastest growing segment of the investment industry, have been for about 2 decades. What they are, it's a basket of bonds or stocks or a mixture of both typically. Sometimes they track commodities as well, some real estate ETFs. There's really an ETF for any flavor, but it's a collection of investments that trades like a stock. So one of the most famous ETFs is QQQ. It follows the NASDAQ. As the NASDAQ goes up, QQQ tracks that because it owns baskets of NASDAQ stocks in the same proportion as the NASDAQ index. ETFs are crucial building blocks of a portfolio in the modern investment sphere. Why are they important? Because they offer tremendous tax advantages compared to mutual funds. As ETFs go up, they typically are going to be rebalancing a couple of times a year. They don't have to pay out capital gains as they rebalance in the same way mutual funds do at the end of the year. So typically when we're talking about building a taxable account for a client, we're going to use either individual stocks or ETFs versus mutual funds because of those inherent built-in tax advantages. We can take the capital gains when we want to versus having the capital gains paid out at the end of the year in a mutual fund when we have to. It provides tremendous flexibility for investors. So ultimately, ETFs are just baskets of stocks, baskets of bonds, the same way mutual funds are. Because of the way they are organized, they are typically passive, but not always. They can sometimes be actively managed in nature, but typically they're passive investments, seek to track indexes, and keep costs very low. Most leading ETFs that we use here at Exencial are less than 0.25% when it comes to their cost structure. Some are even less than 0.1% per year in terms of their cost structure. So they're very efficient both tax-wise, they're very efficient management expense-wise. That's why they're growing so much. That's why they really dominate asset flows, and that's why they're important to know about. If you want some additional information throughout the week about ETFs, about mutual funds, about how we might use them in a portfolio, feel free to follow me on Twitter. As always, OKC CFA CFP. Until then, I'm out.